Well, there's been a lot of talk lately about silver getting ready for an explosive move, and I understand why, because when you put the silver chart next to inflation, energy, debt, central banks, and the way stocks are behaving, it starts to look like this market is not just moving randomly. So, in this video, we're going to separate the excitement from the actual setup, and you are going to walk away feeling a lot smarter, a lot calmer, and a lot more prepared for what could happen next. Today is Friday, May 15th, New York time. And before we get into it, comment below what day and date you're watching from, because I want to see where everyone is watching this silver move from. And if you value this kind of breakdown, subscribe to support the channel and comment John AG Best, because it tells me you want real analysis, not copycat noise. So here's the big question. Is silver really about to explode, or is this just another emotional spike where people get excited at the top and panic on the first pullback? And that is exactly where we need to slow down, because silver can be both things at once. It can be extremely bullish long-term and still punish impatient people short-term. It can be in a real repricing cycle and still drop hard enough to make people think the whole story is over. That is why I do not want you looking at silver like a lottery ticket. I want you looking at it like a pressure gauge. When confidence in paper weakens, when energy costs hit households, when bond yields stop behaving, when central banks quietly prefer metal over promises, silver starts to matter in a very different way. Now, based on recently published numbers, the silver market is still not some perfectly balanced machine. The latest industry updates point to another structural deficit, even though demand has cooled in some areas because high prices changed behavior. Industrial use is still sitting in the mid 600 million ounce area. Mine supply is only around the low 800 million ounce area, and global demand is still a little over 1 billion ounces. So yes, there is weakness in jewelry, coins, and some retail pockets, but the broader physical market is still tight enough that it cannot be dismissed with one bad trading day. And that matters because silver supply does not respond quickly. People hear higher price and they think more supply is coming tomorrow. But mining is not like opening a faucet. You need permits, labor, capital, equipment, energy, water, political stability, and years of planning. And because a large portion of silver comes as a byproduct from mines focused on other metals, even a huge silver rally does not automatically create a huge silver supply response. So when the price dips, do not only ask, why is silver down today? Ask, did the structural story change? Did the world suddenly stop needing electronics, solar, defense systems, grid upgrades, medical equipment, and monetary insurance? Or did a crowded trade simply shake out weak hands? That is the difference. Now let's talk about the monetary side, because this is where the story gets much bigger than one chart. Fiat money runs on confidence. Not gold, not silver, not some physical anchor, just confidence. And when people believe the currency will hold its value, they are comfortable holding paper. But when that belief gets damaged, not in one dramatic day, but gradually, quietly, institutionally, hard assets start moving from the background to the center of the room. This is why central bank gold buying is so important. Recent reserve data shows official sector gold demand started the year very strong, with central banks still adding meaningful amounts even after a huge gold rally. That is not normal retail excitement. That is policy-level behavior. It tells you the people who manage reserves are thinking about uncertainty, sanctions, deficits, geopolitical risk, and the need for an asset that is not somebody else's liability. Now, silver is not gold. We have to be clear about that. Central banks generally buy gold, not silver. Gold is the reserve asset. Gold is the clean monetary signal. Silver is more volatile, smaller, and partly industrial. But that is exactly why silver can become so explosive. Gold moves first because institutions understand it. Silver often moves later because the public finally looks around and says, wait a minute, gold ran, currencies look shaky, industrial demand is real, and silver still looks cheap compared with gold. That is when the move can accelerate. But here's the counterpoint, and I want to be fair. Silver bulls sometimes act like every inflation headline, every war headline, and every dollar scare means silver must go up immediately. That is not true. If the dollar strengthens, if yields rise, if margin calls hit, silver can get smashed. It is not a straight elevator. It is more like a stairwell with trapdoors. You can be right on the destination and still get shaken out on the way. So the question is not whether silver can fall. Of course it can. The question is whether the reasons to own it are becoming stronger or weaker. And right now, I think the reasons are becoming stronger, but the timing is still dangerous if you are emotional. Look at inflation. The latest consumer price update showed headline inflation running in the high 3% area, with energy up sharply from a year ago, and gasoline still carrying real pressure. Core inflation is lower than the headline, but it is not dead. So the Fed is trapped in a very uncomfortable position. Cut too quickly, and inflation expectations can wake back up. stay tight too long, and debt service, credit stress, and economic weakness can become the bigger problem. And the Fed's policy rate is still sitting in the mid 3% range, with the upper end around 3.75%. That is not free money anymore. Households feel it. Businesses feel it. The government feels it. And when the government is carrying total debt that is just shy of $40 trillion, even small changes in refinancing cost matter. That is where the math becomes uncomfortable. This is why the bond market matters for silver. People are trained to call government bonds risk-free. And in one narrow sense, okay, maybe the government can pay you back in dollars, but if those dollars buy less, did you really preserve purchasing power? That is the part people miss. The risk is not always default. Sometimes the risk is repayment in money that has been quietly diluted. Now add energy to that story. The Strait of Hormuz is not just a line on a map. It is one of the most important oil transit points in the world, with around a quarter of seaborne oil trade moving through it and only limited alternative routes available. So when tension rises around that choke point, the market does not just worry about oil. It worries about inflation, shipping, growth, policy, and credibility all at once. If energy spikes, inflation can reheat. If inflation reheats, rate cuts get harder. If rate cuts get harder, debt pressure grows. If debt pressure grows, currency confidence gets questioned. And when currency confidence gets questioned, gold gets attention first, then silver starts getting attention from people who want more upside. That is the loop. Now, some people will say, okay, but if everything is so fragile, why are stocks still so strong? And that is a fair question. But I do not think stock strength automatically proves the system is healthy. Sometimes rising stocks are a sign of optimism. Sometimes they are a sign of liquidity, passive flows, algorithmic momentum, and investors crowding into the same expensive names because the price itself becomes the story. We have seen a market where some companies trade like perfection is already guaranteed. Artificial intelligence names, chip names, mega cap growth names, all of them can attract money, not because the valuation is simple, but because everyone believes someone else will pay more later. And maybe that continues for a while. I'm not here to call the exact top, but I am saying when financial assets are priced for perfection, real assets that are still misunderstood become a lot more interesting. And this is where silver miners come in. Physical silver is simple. You own metal, no management team, no earnings call, no dilution, no mine accident, no political surprise. But miners are different. They can give you leverage to the metal, and they can also give you headaches. If silver keeps moving higher and miners are still priced like nobody believes the move, then the re-rating can be powerful. But if you buy blindly, you can still get hurt. So do not hear silver miners and think easy money. Think leverage, risk, jurisdiction, balance sheet, cost control, and discipline. A real asset can still be a bad investment if you overpay or choose the wrong vehicle. This is why I keep saying preparation beats panic. If you believe silver is in a larger repricing cycle, the time to build your framework is before the crazy candle, not after it. Decide what role silver plays for you. Is it insurance? Is it a trade? Is it a long-term savings asset? Is it minor exposure? Is it a hedge against policy error? Because if you do not know why you own it, the first violent move will make the decision for you. And silver will test you. It always does, especially when conviction feels expensive. If you're successful, share your success story in the comments so others can stay motivated. Because a lot of people are watching this market and trying to build discipline, not just excitement. Now, what would make me more cautious? This is important. If industrial demand weakens faster than expected, if high prices keep forcing substitution, if investment demand fades, if the dollar stays firm, and if real yields rise, silver can struggle. That is the skeptical case. And you need to respect it, because every bullish story has a failure path. But the bullish case is still very alive. Supply is slow. Above-ground metal is not infinite. Industrial use remains broad. Central banks are still validating the hard asset theme through gold. Inflation is sticky enough to matter. Energy risk is not gone. Debt is enormous. And investors are beginning to understand that paper wealth and real purchasing power are not always the same thing. That is the key, period. So, do this immediately does not mean throw your whole account into silver in one emotional moment. It means get your plan straight immediately. Know your levels. Know your risk. Know what you will do if silver pulls back. Know what you will do if silver breaks higher without you. Know the difference between owning physical metal for protection and buying volatile equities for upside. Because if silver really is entering the next phase, the worst position is not being cautious. The worst position is being confused. And honestly, I do not want silver to explode because everything else breaks. That sounds exciting online, but in real life, broken systems hurt real people. The better outcome is a fair repricing where silver reflects its scarcity, gold reflects its reserve role, energy risk is understood, and investors who prepared do not have to chase in panic. But markets do not always give us the clean outcome. Sometimes they ignore a problem, ignore it again, and then suddenly everyone acts shocked when the price finally reacts. That is why I am paying attention now before the crowd wakes up. There's also another angle that almost nobody explains clearly, and it is the inventory psychology. A commodity market can look calm until buyers stop trusting easy replacement. As long as everyone believes metal will always be available at the posted price, inventories feel invisible. But once users, investors, and dealers begin thinking, maybe I should secure supply before someone else does, the same inventory suddenly feels much smaller. That is when premiums can move, delivery times can stretch, and paper price can separate from what real buyers feel in the physical market. Now, I am not saying that is happening everywhere today. That would be too dramatic. I am saying this is how tight markets often evolve. First, the data looks interesting. Then price moves. Then analysts debate whether the move is real. Then physical users get nervous. Then investors finally understand the shortage after the easy part of the move already happened. And silver has one more unique feature. It is cheap enough for regular people to participate. Gold is powerful, but gold feels expensive to a lot of households. Silver still feels reachable. That matters for psychology. If public interest returns in a serious way, it does not take the same amount of money to stress silver that it takes to move larger markets. A smaller market can absorb normal flows, but it can become very jumpy when flows become emotional. That is why the next pullback may actually be the most important test. If silver drops and buyers disappear, then maybe this was mostly heat. But if silver drops, consolidates, and buyers show up again, that tells you the market is not just chasing headlines. It tells you people are using weakness to position. And that is exactly how bigger moves are built. And keep this in mind, a bull market does not need everyone to agree. In fact, early bull markets usually climb through doubt. The headlines argue, the analysts disagree, the shorts press their case, and the price keeps forcing people to reconsider. That is not proof by itself, but it is the kind of behavior that deserves respect. So no, I am not here to scream that silver must go straight up tomorrow. I'm saying the setup has become serious enough that ignoring it is no longer smart. The people waiting for perfect certainty usually arrive late. The people who prepare a plan while everyone else argues are the ones who can act calmly when the market starts moving fast. So watch gold. Watch the gold to silver relationship. Watch energy. Watch the bond market. Watch the dollar. Watch whether silver holds support after sharp selling. And watch whether miners start confirming the metal instead of lagging behind it. Subscribe if you want more straight breakdowns like this, and comment below whether you think silver is still early or already overheated. I want to see where this community stands. And remember, this is education and discussion only. I am not telling you to buy, sell, or hold anything. Your money, your risk, your timeline, and your responsibilities are yours. Use this as a framework to think clearly, not as personal financial advice.